Will the forces shaping global markets in the coming months actually boost your portfolio? Or could they leave it feeling a bit under pressure?
That really is the core question, isn't it?
It is, and that's what we're diving into today. Welcome to the Deep Dive.
Good to be here.
Our mission, as always, is to cut through all the noise. We want to extract the most crucial insights from, well, a stack of fresh reports.
And today we're focused on the WS Global CIO Office's Global Market Outlook from June 2025. A pretty comprehensive look ahead.
Exactly. The goal here is simple. Give you a shortcut to being truly well-informed. We'll highlight what's genuinely important, what you really need to keep a close eye on for the second half of 2025.
And right at the heart of this outlook, there's a pretty significant prediction that stands out.
Which is?
The weakening of the US dollar. So we're going to unpack exactly what that could mean for your investments globally.
Okay.
Where the most compelling opportunities might lie, and crucially, what risks demand your attention as we navigate H2 2025.
All right, let's delve right into that prediction then. The report's core strategy for the second half, H2 2025, it really revolves around positioning for a weaker US dollar. So why? What are the big drivers behind this forecast? Why is this expectation so central to their outlook?
Well, the report points to a confluence of factors, really. You're seeing expectations of global policy easing.
Meaning central banks outside the U.S. getting more accommodative.
Exactly. Plus, there's a strong probability, they think, of a U.S. soft landing. So growth moderates, but no recession.
Right.
And, the U.S. dollar itself is still, well, pretty highly valued, arguably overvalued.
Right.
Then on a more cyclical level, say over the next 6-12 months, we're likely looking at lower interest rate differentials between the U.S. and other major economies.
Which makes the dollar less attractive for those carry trades.
Precisely. And then there's that ongoing uncertainty around U.S. trade policy. You put all those elements together.
And it creates a kind of gravitational pull downwards for the dollar.
That's the idea. A strong case for it to weaken from current levels.
That makes sense. So if the dollar does weaken, how does that ripple through other currencies? Who stands to benefit most here?
Well, if the U.S. dollar weakens, as they project, the report sees the euro, the Japanese yen, and the British pound as the primary winners.
Okay, the major pairs.
Yeah. The Swiss franc, on the other hand, probably stays relatively stable, sort of range-bound.
And Singapore.
Interestingly, the Singapore dollar is anticipated to weaken a bit from the top of its policy band. So maybe the MAS allows for some depreciation there.
Now, this next point from the report really shifts in my perspective on equities. They're saying a weaker dollar is actually seen as a positive for global stock market returns. That seems counterintuitive, maybe?
It does at first glance, yeah. But what's truly insightful here is the nuance.
Go on.
While a weaker U.S. dollar is broadly positive for global equity markets, and that includes U.S. equities too.
Okay.
Historical data shows a really crucial pattern. It typically leads to non-U.S. equities outperforming their American counterparts.
Ah, so it's a relative game.
Exactly. It's not just a rising tide lifting all boats. It's a tide that tends to lift the non-U.S. boats disproportionately higher.
Got it.
And this understanding, this is really foundational for the report's overweight global equities view.
Okay, so given this bullish stance overall on global equities, where specifically should we be looking? Where are the most compelling opportunities right now? The report mentions some interesting regional upgrades.
Absolutely. The major upgrade is Asia ex-Japan. That whole region's been moved to an overweight position.
Why the shift there?
Well, it's primed to benefit quite significantly from a weaker U.S. dollar, for starters. Plus, you've got attractive valuations and some strong internal economic drivers kicking in.
And within Asia ex-Japan, any specific standouts?
Definitely. Korea is upgraded to overweight.
Okay, Korea.
Yeah, you've got appealing valuations there, pretty robust growth prospects, and critically, a significant reversal of foreign fund outflows. We saw 9 months of outflows turn into strong inflows since May. That's a big shift.
And the new government there.
Exactly. The new administration's expected fiscal expansion and market reforms, like that whole KOSPI 5000 campaign.
Aiming to boost valuations.
Right. Boost corporate valuations, shareholder returns. Those are acting as powerful potential catalysts.
Okay. And what about China? That market's certainly been, well, volatile and in focus.
China's retained as an overweight. It seems Beijing skillfully used its rare earth leverage, to de-escalate some of those trade tensions.
It is a positive development.
It is. And valuations still look appealing. The MSCI China Index is trading at, what, roughly a 40% discount to global equities?
Wow, that's significant.
It is. The report indicates a preference for offshore Chinese equities, though, mainly because they have a higher weighting in growth-oriented stocks.
Like tech and consumer.
Yeah, specifically favoring cyclical technology, communication services, and consumer discretionary sectors.
And India, still a core holding.
India remains a core holding, absolutely. Driven by those strong structural dynamics, it's increasingly favorable geopolitical positioning, and you've got fiscal stimulus providing an additional tailwind. The recommendation there, though, leans towards large caps over small and mid caps.
Due to valuation.
Primarily valuation considerations, yes.
Yeah.
Small and mid caps have had a strong run.
Got it. Beyond Asia, are there other non-U.S. markets looking attractive?
Yes, European equities are still viewed pretty attractively.
Okay.
They offer compelling valuations, relatively speaking, and the expected fiscal spending across the continent should provide some solid support for earnings growth.
Any specific sectors in Europe?
Yeah, the report highlights overweights in European banks and industrial specifically.
Okay. And let's circle back to the U.S. then. American equities, they're still a core allocation, obviously.
Absolutely.
But is there a particular strategy here, or maybe a catch, given that weaker dollar outlook we discussed?
Yeah, there's definitely a strategic nuance to consider. Look, U.S. equities clearly benefit from a U.S. soft landing scenario and also from a weaker U.S. dollar.
Especially if the Fed cuts rates later this year.
Especially then, yes, if the Fed does cut in H2 2025, as many anticipate. But, and this is the key point, you have to remember that historical evidence strongly suggests they struggle to outperform non-U.S. equities when the U.S. dollar is falling.
Right, that relative performance point again.
Exactly. So while they're absolutely a core part of the portfolio, the report recommends favoring certain sectors within the U.S. market.
Which ones?
Cyclical financials, technology, and communication services. It also specifically notes that U.S. software seems quite resilient to tariffs.
Interesting.
And major U.S. banks could stand to gain from expected deregulation.
Okay, so that covers the equity side quite comprehensively. But what about the, let's say, steadier income-generating part of the portfolio, fixed income?
Right.
For listeners focusing on bonds, how does this H2 2025 outlook reshape that landscape?
Well, the key upgrade in the bond space is emerging market local currency bonds, EMLCY.
Okay.
They're now overweight. And this move is strongly supported by that expected weak U.S. dollar trend we talked about.
Makes sense. Capital flows.
Exactly. Plus, ongoing rate cuts by many EM central banks, generally benign local inflation environments, and, pretty strong fiscal positions in many of these economies.
And diversification.
Critically, yes. This asset class offers excellent diversification benefits because it has a low correlation typically with developed markets or DMs.
Got it.
And as a sort of new opportunistic idea within this space, EM and Asia LCY bonds are particularly highlighted.
Why Asia specifically?
They're expected to attract significant fund flows from a weaker U.S. dollar, plus they offer those valuable diversification benefits within the broader EM context.
Okay, and for U.S. bonds, are we looking at specific maturities, long end, short end?
For U.S. dollar bonds, the strategy favors the middle ground, specifically 5 to 7 year maturities.
The belly of the curve.
Precisely. It's seen as the sweet spot, offering the best kind of trade-off between still attractive yields and potential price gains if rates fall.
Right.
While helping investors avoid maybe excessive exposure to inflation or fiscal deficit risks that can be more pronounced in those longer maturities.
Makes sense. When are high-quality bonds most attractive then?
The report suggests high-quality bonds look particularly attractive when the 10-year U.S. Treasury yield is around 4.50% or higher.
And the expectation is for yields to fall.
Yes. The anticipation is for a move down towards the 4.0% to 4.25% range in the next 6 to 12 months.
Okay. Now, were there any specific bonds or bond categories that got downgraded in this report? Areas to maybe approach with more caution?
Yes, there was one notable downgrade. Developed market investment grade corporate bonds, DMIG corporates, they're now underweight.
Why the downgrade there?
It's primarily due to their increasingly tight valuations. Their prices look pretty high relative to the yield they offer.
Spreads are tight.
Exactly. And the report also highlights risks of those spreads widening, maybe stemming from ongoing uncertainties about U.S. growth.
Okay, so caution on DMIG. Beyond those core calls, any other specific bond opportunities listeners might consider opportunistically.
Absolutely. A couple are highlighted. U.S. Treasury inflation-protected securities, or TPS.
For inflation uncertainty.
Exactly. If you're worried about inflation surprising to the upside, TPS are a way to navigate that. Also, UK gilts.
British government bonds.
Right. Specifically FX unhedged ones.
Meaning you take the currency risk or potential reward.
Correct. The idea is you get a nominal yield pickup compared to some other markets, plus the potential for gains if the British pound strengthens, which aligns with the weaker dollar view.
Interesting. Okay, so we've got this generally constructive outlook, weaker dollar, opportunities in equities and bonds. But reports like this always outline potential roadblocks.
Of course. There are always risks.
So what are the key ones? What should listeners be really keenly monitoring in the second half of 2025?
The report outlines several top risks that could definitely disrupt this base case scenario. First, renewed trade tariffs.
Right, the deadline.
Early July marks the end of that 90-day tariff pause we've seen. Now, while extensions for more discussions are generally expected,
The rhetoric could heat up anyway.
for sure, the rhetoric around trade policy will certainly be present, and a sustained rise in trade tariffs is flagged as a top risk.
Especially given where rates are already.
Exactly. Consider this. The U.S. effective tariff rate is already at 14.5%. That's a level not seen since 1938.
Wow, 1938. That really puts it into perspective. What else is on the risk radar?
Second big one, an oil price shock.
Geopolitics.
Yeah. Conflicts in the Middle East, Ukraine, and Russia, they continue. If there's an escalation that leads to a direct oil supply disruption, think something happening in the Strait of Hormuz.
A choke point.
Exactly. That could push oil prices significantly above $100 per barrel.
And the knock-on effects.
Well, that directly fuels inflation expectations, right? And it severely limits the Federal Reserve's flexibility to cut rates, even if growth is slowing. That kind of scenario has historically been a trigger for U.S. recessions.
Okay, tariffs, oil shock. What's third?
Third is the potential impact of something called Section 899. It's a proposed section in the U.S. budget bill.
Section 899, what does it do?
It could potentially allow U.S. policymakers to impose taxes on investments coming from markets they deem to have discriminatory taxation policies. They cite examples like European digital taxes.
That sounds complicated and potentially disruptive.
It does. It raises pretty significant concerns about its potential negative impact on investment flows into the U.S. and therefore on the valuations of U.S. stocks, bonds, and even the U.S. dollar itself.
When might that happen?
Implementation is currently scheduled for 2026, but honestly, clarity is still needed from the Senate. It's something to watch.
Definitely. And the final risk?
The final key risk is simply a sudden, swift decline in U.S. hard economic data.
So the soft landing doesn't materialize.
Right. Despite the recent resilience we've seen, a rapid downturn in economic indicators towards recessionary levels remains a possibility. We're already seeing some signs of slowing in the U.S. job market, for instance.
Such as?
Well, job openings are now almost matching the number of jobless people for the first time since the pandemic began. That's a sign the labor market is cooling.
Okay, so that job market point really stands out. You mentioned the base case is a 55% chance of a soft landing.
Correct.
What's the most likely trigger in the report's view for that 25% hard landing or recession scenario? Is it mainly that employment picture deteriorating further?
Yeah, I think that's the core of it. In the report's view, for that 25% chance of a hard landing, a swift deterioration in the job market is key. Combine that with inflation staying stubbornly high or sticky.
Preventing the Fed from cutting rates.
Exactly. Preventing the Fed from easing even as growth slows down, that would be the primary catalyst for tipping into recession.
Yeah, and the no landing scenario.
Yeah.
Stronger growth.
That's seen its probability reduced, actually, down to 20%. So the balance of probabilities has shifted more firmly towards either that soft landing or potentially a mild downturn.
Okay. Now, we've talked a lot about cyclical U.S. dollar weakness, the next 6-12 months. But the report also touches on a much bigger, more structural question. Is the dollar's global dominance, its reign, truly diminishing over the long term?
Yeah, they do wade into that debate.
And if it is there any credible challenger actually on the horizon?
Look, the report offers a pretty nuanced perspective here. On the one hand, there's no immediate, obvious, credible challenger to the dollar right now.
Why not the euro, for example?
Well, the euro still lacks a true fiscal union, a unified treasury, and it doesn't have the same depth and integration in its bond and equity markets as the U.S.
And the Chinese renminbi?
Still constrained by capital controls, that limits its global appeal as a reserve currency.
But is the dollar's role eroding anyway?
Yes. The report argues the U.S. dollar supremacy is indeed slowly eroding over time.
What's the evidence for that?
Well, look at its share in global foreign exchange reserves. It's fallen from around 70% 2 decades ago to about 58% today. That's a noticeable decline.
Okay.
We're also seeing more trade, particularly in emerging markets, increasingly bypassing the U.S. dollar, settling in local currencies or other alternatives.
And the U.S. debt situation.
That's another factor. U.S. federal debt is projected to hit 118% of GDP within a decade. That naturally raises some long-term questions about the appeal of U.S. government bonds as the ultimate safe asset.
There's also mention of the USD smile fading. What's that?
The dollar smile. That's the historical tendency for the dollar to strengthen significantly, both when the U.S. economy is booming and during times of global stress or risk aversion, like a smile shape on a chart.
Okay.
That tendency seems to be fading. The dollar isn't rallying as strongly during risk-off periods as it used to.
And the implication?
It makes being unhedged against dollar fluctuations more financially painful for international investors. And that's leading to increasing foreign exchange hedging activity. People aren't relying on that safe haven rally as much.
So, if the dollar's traditional role is diminishing, even slowly, over the long term, what's the ultimate diversification play? What asset really offers shelter in that kind of world?
Gold. It stands out as a really clear potential winner from this whole de-dollarization narrative or push.
Why gold specifically?
Central bank demand is a huge part of it, particularly from emerging markets like the People's Bank of China. Their buying has been exceptionally strong.
Is there data on that?
Yeah, a recent survey revealed that 76% of central banks surveyed believe gold will comprise a higher share of global reserves in the next 5 years. That's up from 69% just last year.
Wow. That's a strong consensus.
It really is. And gold now accounts for roughly 18% of global reserves overall, up from just 11% back in 2018.
So it's a structural shift.
It looks like it. Gold serves as a crucial portfolio diversifier, especially maybe in environments where traditional bonds aren't providing that same level of protection as effectively.
And the price outlook.
The report anticipates gold potentially transitioning to a higher price regime, possibly exceeding USD 3,000 an ounce for the remainder of 2025.
Okay, so gold is key. Any other diversifiers mentioned?
Briefly, yes. Alternative strategies are also highlighted. Things like equity long-short strategies.
Benefiting from picking winners and losers.
Exactly. Benefiting from stock and sector dispersion while still having exposure to a generally bullish equity view. And also private credit strategies.
Offering yield without duration risk.
Offering attractive yields without that significant interest rate sensitivity, yeah.
Okay. Now, for listeners who are very focused on income generation.
Right.
The report also discusses multi-asset income strategies, or MAI.
Mm-hmm.
How have those types of strategies actually fared amid all the recent market volatility?
Well, the report indicates that their specific multi-asset income strategy showed pretty notable resilience through the second quarter of 2025.
What were the numbers?
It delivered a positive 2.1% return over the past 3 months. And crucially, it's maintained a steady income yield of approximately 5.7%.
Which is quite attractive in the current rate environment.
It is, yeah.
Yeah.
Quite attractive given where rates are.
So that's a solid performance looking back. How is this MAI strategy positioned looking ahead, especially with those potential Fed rate cuts on the horizon?
Well, the strategy continues to lean slightly in favor of equities over fixed income overall. It's trying to strike a balance between income-generating assets and more traditional growth equities.
And the weak dollar view plays in.
Yes. That weaker U.S. dollar outlook specifically supports increased allocations into those emerging market local currency bonds we discussed earlier.
Okay.
Additionally, they expect U.S. agency mortgage-backed securities, MBS, to continue outperforming developed market investment-grade government bonds.
Got it. The report also mentions contingent convertibles, COCOs.
Ah, yes, COCOs, those hybrid bank capital instruments.
How have they done?
They've actually delivered pretty impressive performance, up 9.1% year-to-date and 14.8% over the last 12 months. That's even outpacing global equities.
Wow. So are they still overweight COCOs?
Actually, no. After such a strong run and consequently tightened valuations, the report notes the overweight position in COCOs has been prudently reduced.
Taking some profits.
Seems like it, though they still offer comparatively high yields relative to standard investment-grade bonds.
So the overall message for income is diversification.
Absolutely. The core message is crystal clear. A well-diversified income portfolio is key. Mixing different types of assets, traditional fixed income like EM/LCY bonds, equity income assets like global dividend payers, and these hybrid instruments like COCOs that kind of mix is designed to be more resilient and more adaptable to whatever market uncertainties come our way.
Okay, great. Now, beyond all the fundamental analysis and the macro views, what about the quantitative side? What do the models tell us about the market's current state and outlook? Are they sending any interesting signals?
Yeah, there are a couple of key takeaways from the quant models. First, their long-term stock bond model. This typically looks at about 3 to 6 months.
Okay.
It's actually turned neutral. It's scoring 0 out of 5 now, which is down from a previous +1 score.
Huh. Why the downgrade to neutral? Especially if fundamentals are improving.
That's the interesting part. It's despite improving fundamentals. For instance, market risk aversion has fallen sharply since April, and the economic surprise index has turned slightly positive.
So why neutral?
The key reason cited for the shift down is that valuations for developed market equities now look slightly rich to the model.
Valuation concerns creeping in.
Exactly. It seems that valuation concern is outweighing some of the good news seen elsewhere in the model's inputs right now.
Got it. And what about the very short-term technical view? Momentum, trends.
The short-term technical model, which focuses more on a 1 to 3 month horizon, it actually maintains a bullish bias view on most equity markets.
Oh, more positive short-term.
Yeah, it's specifically bullish on US, UK, and Japan equities for the next 3 months or so.
And the reasoning there?
Primarily because market trends, momentum remain favorable, and volatility has subsided quite significantly from some of the highs we saw earlier in the year.
Okay. But is there a warning anywhere in the technicals?
There is one specific warning flag raised. It relates to emerging market local currency bonds.
Which we just talked about as a key overweight.
Exactly. While they've been strong performers and are favored fundamentally, the model's market diversity indicator is flagging potentially stretched investor positioning.
Meaning too many people crowded into the trade.
Potentially, yeah. And that raises the risk of a short-term reversal or pullback for these EM/LCY bonds, even if the longer-term view remains positive. Something to be mindful of.
Okay, so a bit of caution there on the short-term positioning. Right? Well, I think that covers a huge amount of ground.
It's a lot to digest, for sure.
So there you have it. A pretty comprehensive deep dive into the H2 2025 global market outlook. We've definitely seen a clear call for a potentially weaker dollar.
That's central.
Specific equity opportunities highlighted, particularly in Asia and maybe Europe.
Right, the regional tilts.
Some strategic bond plays, especially in EM local currency.
And that 5-7-year U.S. duration spot.
And, of course, a very vigilant eye needed on those key risks, like trade tariffs and potential oil price shocks.
I think the overarching message, really, is that while some volatility is probably going to persist,
Almost certainly.
the base case anticipates a constructive environment for both economic and earnings growth overall.
And the key strategy remains
Diversification. It sounds simple, but it remains absolutely paramount, not just across asset classes, but maybe thinking about diversifying across income sources, too, as we discussed with the MAI strategy.
That's a great point. Remember, just understanding these dynamics, these potential shifts, can truly empower you to make more informed decisions about your own wealth, your own portfolio.
It really can. And maybe it leaves us with a final thought to ponder. As this global financial landscape continues to shift, maybe faster than we expect sometimes, how might the role of those traditional safe haven assets evolve? Thinking beyond just the next 6 months, maybe over the coming years, beyond even what we've discussed today.
Like what comes after gold, maybe?
Perhaps, or what unexpected assets might emerge as the new anchors of stability in what seems like an ever-changing world.
That is definitely something for you to mull on until our next deep dive.